So terrific to have you here with us, Mujtaba. These are all our fellows. They come from different backgrounds. We also have a couple of students from our Network Capital School. And we are just going through this EdTech fellowship because we run a wide range of these live cohort-based programs that helps people build their category of one. So really love the fact that you've worked at BlackRock as well, which is where my brother works right now, and then at GSV where you're looking at education. So thrilled to have you here with us.
Awesome, happy to be here. Thanks for inviting me.
Great. So Mujtaba, tell us a bit about yourself, your foundational years. You went to Yale, studied liberal arts. How did you start getting interested in finance? How did education come to you?
Yeah, so as the classic phrase is that there's no normal path to VC, right? Everyone has sort of a roundabout way of getting there. Both my parents are lawyers by training. My older sister went to law school as a corporate lawyer. That was kind of what I was groomed for as a child. My dad declared when I was in second grade, or class 2, as they say in India, that I should go to Yale because Yale law is like the creme de la creme, and that was kind of what he was aspiring for me. But I was always also interested in business and investing. I had my first job when I was in 11th grade. I made a couple $1,000s and put like all of it into stocks. My AP Econ teacher in high school told me, you should buy some ETFs. I was like, that sounds so terribly boring. And instead I was buying Apple and Tesla and that kind of thing. Unfortunately, I sold the Tesla stock in January of 2020 when it was trading at 5 times revenue, and I thought, 5 times revenue for a hardware business is too much. I should take my money and leave. It's like 6x since then. Even if I walked away with 4 times my money, it could have been a lot more. Anyways, when I started at Yale, I wanted to study what it's their version of the classic Oxford PP&E program, ethics, politics, and economics. Normally when people give sort of generic advice, I ignore them. The dean of my college gave an opening speech to all the freshmen saying, explore things, don't do just what you thought you were going to do when you came here, try new things, find your passion, all that kind of stuff. And in my head, the entire time I was thinking, this is a bunch of nonsense. This is for, this is not for people like me, not for people who are raised like me with a plan and with goal-oriented parents, not for someone from the subcontinent or a Chinese family or anything like that with, your parents knew you were going to be a doctor when you were born, or maybe before you were born. But I don't know why, I listened, I tried some random courses. I found the liberal arts, the humanities much more interesting than economics. I found doing problem sets and sitting in lecture rooms of 400 kids is boring, or even if there were lectures of 50 kids versus being a seminar room of 15 students discussing something, whether it was South Asian history or politics or the Bible. I found it all much more enriching than doing math problems. But to some degree, that's a luxury, a privilege. I think if you're lucky enough to go to a place like Yale, you have sort of a brand background and a network of connections and alumni that will allow you to open up opportunities, even if you study something like humanities. So even today, I often meet people and they ask me, oh, what did you study? Did you study finance? And I'm like, no, I studied humanities. And they're all just confused how I ended up, becoming an investor. But anyways, this has gone really, this has been extremely tangential and long. Basically, I used my clubs and internships in college to try different things. I worked in government, I worked in law, I did all those sorts of things. And I met someone who knew someone, and I ended up spending a summer at BlackRock in a private equity role. I found investing professionally much more interesting, even though at that point I had no idea about private markets, venture capital, any of that. And then, I did that. I returned full time. I spent a few years doing that. In that ecosystem, we did everything from credit, take privates, any private markets transaction to late stage venture. I found the late stage venture things way more fascinating, right? It's much less sitting in Excel and tweaking assumptions behind models and figuring out how your 2.5x could be a 2x, or when you lose your money because of the interest rate coverage, versus, you know, venture, you're talking, you could be 0, you could be 100. It's just much closer, much more tactile, much more dynamic. So I really liked that. And, you know, I essentially tried to get into venture. I wanted to do mission-driven work. You know, I didn't want to invest in another consumer product that nobody needs. You know, was fortunate to get.
know a bunch of them.
Yeah, exactly. And was fortunate to get introduced to the folks at GSV. Have been at GSV now for 16, 17 months. I joined just at the start of the pandemic. Until a month ago, I had never met any of my colleagues. I met them at the end of July, which was cool. But yeah, it's been a crazy ride. I've sourced maybe 6 or 7 investments in this time. We've done 8 or 9 deals in India. We've been super active globally. Yeah, it's been a lot of fun.
That's amazing. What is GSV, and what's GSV's theory of change? Because it's a very interesting organization. You guys have invested in some of the most iconic education companies from the wave 1 and wave 2 disruption era. So give us a bit of a background about it, and tell us about some of the deals that you've scouted. ClassPass, for example.
Yeah, GSV, it has a long dynamic history that can be confusing to folks on the outside. In short, Deborah Quazzo heads the fund, and a figure named Michael Moe, who's an advisor but not a formal part of the venture fund. They knew each other in the mid-90s and were bankers at the time. Michael Moe was an equity research analyst, and he wrote a white paper in 1996 about digital education, about how there are all these parallels between healthcare and education, massive multi-trillion-dollar fragmented markets, how there'll be consolidation, huge space for innovation and disruption for the coming decades. And he really brought education to Deborah. They started a firm together in 2001 called Think Equity Partners, which they sold in 2007, I believe, to a British asset manager. After those non-competes expired in 2008, they started GSV really to do a few different things. They had a generalist growth fund, which was not education specific, which Michael Moe ran. They had an education-focused advisory practice, which Deborah ran, and the ASU GSV Summit, which is this large education conference we do every year now in San Diego. 2019, we had like 5,500 people. 2020 was virtual. And we had the conference again in August in person, maybe 3,700 people, which was pretty terrific turnout for sort of a COVID year with no international travel. Through that conference and the advisory business and all of that, they really built a huge network of global entrepreneurs, right? Great relationships with Tao and Oriental. I think Mayank from Upgrad was coming to the summit from 2015. Baiju spoke at the summit in 2017. And, you know, through that, Deborah started doing a ton of angel investing. She did 60 or 70 angel investments. Off of that, raised a fund, a $100 million fund in 2016. And that kind of just got the ball going. 2019, raised fund 2, which sort of we raised and deployed at the same time. So we're almost fully invested there, and we're, you know, hoping to have a first close on a $300 million fund in October. Fund 1 was very US focused. There was only one non-US deal, a company in Europe. Fund 2 is sort of right around when I joined. We were looking at our first international opportunity, and Deborah just kind of asked me to take charge of that and drive the global business. And it's been incredible. I mean, I think the pandemic added a lot of comfort around doing deals without meeting folks. And obviously, Indian EdTech specifically exploded. And you know, now we've had not just Baiju's, but Unacademy and Upgrad and all of these other things proving out the space. And yeah, I mean, I think I've met at least 400 founders in the Indian EdTech space in the last 15, 16 months. We've made 7 or 8 commitments, 4 which are closed and announced: ClassPlus, Lead School, Quizzes, and Techie. And you know, you can see that sort of across the spectrum, everything from seed to Series C, Series D deals. Yeah.
So a lot has been written about the Indian EdTech space. You wrote an article about ClassPlus and what it's trying to do, becoming the Shopify for education. Tell us a bit about how you scouted for these deals. What was the process looking like, and what about the Indian EdTech has been really surprising and different from other markets?
So In terms of scouting, I'd say in the beginning, it was just leveraging a lot of the networks that we already had. Michael Moe had a long-standing partnership with Times of India. We had an advisor in India, a woman named Kami, who now is an executive at FedEx, and she used to run her own education company. And really just leveraging introductions through that network. So we met a lot of folks, met a lot of companies. Deborah would get random inbound from Indian companies. She sat on the board of Akash through a relationship with Blackstone. So we had some relationships. And it was, at the beginning, it was just leveraging those relationships to talk to anyone who would talk, any investor, any company, anybody who's interested in us. And then after sort of building that volume, we were much more capable of sort of picking our spots. What are areas we find really interesting? What are areas we're not that interested in? Where do you think we can really leverage our strengths? And through that, we started to really figure out why we really liked the SaaS model. And we thought Class Plus was the leader. We always love to invest in leaders that we think will be the winner of a category. And Class Plus is clearly in the pole position in that space. We love to partner with great investors, especially when we were entering the market in the beginning. So we have a great relationship with Karthik and Sajid and Radhika at Bloom, and they've been terrific partners. And yeah, almost everything we've done has been some sort of partnership. We got introduced to lead school through Sandeep at Alabar. Some of the other deals that we've done that maybe aren't announced, we got connected through people that we knew previously, or through Vibe at Better Capital. It's a lot of it has been partnership driven. We want to be we really think if you look at the ecosystem, there is a good amount of seed capital, not very much pre-seed capital, and then not very much high quality Series A plus capital. There's a handful of really strong funds, and we have good relations with all of them, and all of them would sort of love to have a education specialist on the cap table. Yeah, and then sorry, the other part of your question I think was around surprises. There are a bunch of things. I would say it is funny how many people can be building the same business. There's like a couple dozen kids, academic, small group, one-on-one tutoring businesses. There are a couple dozen kids, extracurricular development businesses. There are things I like in businesses and that I think are patterned specifically to India of both what makes them appealing and what makes them not appealing. I would say, we've stayed away from not a single business I think we've done, you'll see, is in the digital marketing treadmill, not one. They all have some sort of differentiated customer acquisition channel, go-to-market strategy, and not one of them is sort of a clone, right? We're not going to do anything that there's 12 people doing the same thing. And I think that goes back to sort of what your motivation is and what you want to build. We really love investing in mission-driven founders, product-first founders who are doing this because they care about what they're doing. Hope just like us, we want to do well and want our investments to perform well. But we're not in this just for returns. And clones companies are almost always made by people who are in it just for sort of a quick buck. And that's not what we're underwriting. We're as a Silicon Valley venture firm, we want to invest in companies that we think can be multi-billion-dollar winners. We don't want to invest in a company that gets sold for $10-50 million, even if it's a 5, 10, 15x. It's not what we're looking for.
Yeah, that's really interesting. I think you also have a 5P framework, which I think will be very useful to our fellows to understand about what kind of education companies does GSV actually fund, and how do you use the 5P framework to make investment decisions?
Absolutely. It's very simple, and I kind of alluded to the 5th P, purpose, in my previous answer. The 5 Ps are, number one, people. It's always people first. Venture investors like to say, we would rather invest in a great founder with an okay idea than a great idea and an okay founder. The business model can change, the whole idea can change, but if you really believe in the management team and in the founding team, that's what will drive a business. If we look at the most successful businesses in our portfolio across the board, Coursera, Course Hero, degreed, guild education. These are some really, really high quality people. And when you meet them the first time, you're really impressed by them. And the more time you spend with them, the more excited you are by their capabilities, by how sharp they are, by their insight, by their ability to attract talent, right? Who do they put around them? That's all, maybe the most important factor. How good are they at building a team? So number one is people, by far the most important. Number two is product. That goes back to what I was saying earlier as well. We're not trying to invest in just services. A lot of the companies are taking some sort of offline service and just making it digital. When we're really trying to invest in product first businesses. We love quizzes. That is a real product. Their team until maybe a few weeks ago was under 30 people, and at peak in the academic season they served like 70 million users. That's what you call a scalable, differentiated product that grows organically, so we love that. The third P is potential, and that gets back to market opportunity. India, of course, is an amazing opportunity. There's great opportunities in Southeast Asia and in other regions, and that also ties into competition, right? Is it just another B2C digital marketing sales machine more than anything else? So that's very important. Potential. The fourth piece, predictability, and this depends greatly on the stage of business. For sort of a pre-seed product stage business, there's not much to go on. But for a later stage company, we're really trying to evaluate all the metrics, whether that's growth, retention, the unit economics, LTV to CAC, all these sort of things. We really want to understand them. And then the last one, of course, as I was talking about earlier, was purpose. We want to invest in mission-driven founders who we think really care about what they're doing and are not sort of narrowly motivated.
Yeah. Thanks, Mujtaba. This is delightfully interesting. Let me pause for a minute. I think our fellows may have questions. So fellows, any questions so far? If not, I can keep going on, but just wanted to stop for you. All right. Yes,
Mujtaba, actually, you said something about like like a digital marketing sales machine versus organic growth. Can you just elaborate a little bit to
Sure.
on that point? Yeah.
So there's nothing wrong with marketing your product. With building a great sales organization is actually really important. In 0 to 1, Peter Thiel's book, he talks about this. There's sort of always a debate in startups and among founders in venture about if you build it, will they come? And even if you look at the best enterprise SaaS products in the world, whether that's Snowflake or Twilio or something like that, they all have really robust sales and marketing functions. So that's really important. That's really important to get right. And I'm not saying that a consumer education company should not engage in digital marketing. What I'm trying to really underline is that cannot be the sole lifeblood of the business, right? There are a lot of businesses out there in the market that are the only way they acquire customers is by running ads on Facebook and Instagram and that sort of thing. And that can be extremely problematic. We talked to some businesses last year where in the pandemic, digital marketing costs were rising by like 50, 60, 70% month over month. The cost of acquisition was just skyrocketing. And if a business is reliant on that as their primary channel of acquisition, it's just an extremely high risk, and it creates really problematic unit economics, right? The benchmark number out there is for LTV to CAC is 3. So, a lifetime value of $300 to a customer acquisition cost of $100. Great businesses usually have something much higher than that. And that brings in a whole nother conversation about retention, which goes back to, just building a really great product. So yeah, happy to expound on that if there are any specific questions, but hopefully that's helpful.
Yeah. I think what Mujtaba is referring to, having a real competitive differentiator beyond a strong sales engine, not discounting the fact that sales engines also matter. at different
I
points
have a
in time.
question, Utkarsh, if you allow me to ask.
Yeah, please go ahead.
Yeah. So, Mujtaba, I want you to, if you could please explain further on your statement that customer acquisition cost um, and sales engine. So you mentioned about sustainability of a business and how much dependency on advertisement there should be. Like for example, if you talk about companies like Byju's, etc., they're also spending huge amount of money in generating leads through their ads, right? So most of the edtech companies in today's space are focusing through that because no matter how much you rank organically, you need leads coming through ads as well. So what is wrong in that kind of a model? Is what my
Yeah.
question to you is.
And just to underline and repeat, right? There's nothing wrong with digital marketing, and there's nothing wrong with having a great sales organization. And the reason Byju's is such a successful business today, one of the many reasons, is because they built an extremely efficient and extremely robust sales engine. So there's nothing wrong with that fundamentally. The issue is that how it's executed, especially in the sort of first few years of business, makes a massive difference to the overall long-term health of your company. So, if we take a few steps back, any company's value is a discount to the expected future cash flows. At some point, whether it's in 5 years, 10 years, 20 years, the company has to, produce cash, has to be profitable. Byju's today is profitable, even though they have a massive sales force and spend, a huge amount of capital on sales and marketing. And I forget how many salespeople they have. Maybe it's like 3, 4, 5,000. Even though they do that, their unit economics work. Their LTV is so long, their cash flow is so impressive that at scale it's working. The problem is many companies in the early days have sort of unprofitable unit economics, and to some degree that's fine, it's quite normal. But the question is, at what level of scale will that even out? Will your sales force be so efficient? Will your LTV be extended to a broader product offering to a higher retention number, that the numbers actually work, right? Like the math has to add up at some point. And my core point, if you will, on the digital marketing spend issue is that I would say most of the companies that I've met that are digital marketing reliant at the seed stage in Indian EdTech, I don't believe will ever be profitable. I think they will close, or somebody will buy them for a very cheap price because their product is not differentiated enough. Their go-to-market strategy is not differentiated enough to reduce their CAC or something like that. Their organic growth is not strong enough. I don't believe they'll ever be profitable. I don't believe it'll work, because you have to get to a certain scale and have a level of organic growth and referrals and retention, all of that, for the math to actually add up. And yeah, I'd say my core point is the math for a lot of early stage businesses is not adding up, and I don't think will add up.
Okay, so what I understand is sustainability and profitability is what you mean. You don't have any problem with the spend on advertisement. So ideally, investors or maybe people who just check out the reliability of a company from investment perspective, what should be the percentage of referrals or leads which are coming without any cost of customer acquisition? What should be that percentage which investors look at?
Yeah.
By that I mean maybe referrals or maybe automatic admissions.
Yeah, it really depends. This number it's important to benchmark and to have sort of KPIs that are standard, but it depends. Is your product a really expensive product or a very affordable product? Is it a long tail, or is it sort of a short consumption?
Maybe if they are in the upskilling, reskilling space and the average ticket size is $300, $400, in the same space where you have Upgrad and all these companies in the upskilling, reskilling space.
Yeah, and if the average ticket size is $300, $400, what's kind of how many customers are repeat purchasers?
I didn't get your question. Can you say that again?
How many customers are repeat purchasers?
Repurchases. You mean upgrading the course from one course to another?
Yeah.
Okay. Roughly, currently we have around 10%, 5 to 10% customers who are maybe 5% who are upgrading themselves from a regular course to a postgraduate program, or maybe maybe we are able to upsell them. Yeah.
Yeah. So the way to think about it is, let's say you're selling something that's $300, and only 10% of people are going to purchase again. So you're talking sort of a $350 LTV. If you're talking a $350 LTV, then you really want the cost of acquisition to be $100 or less. You can probably make the business work if it's $150, but it's not going to be an extremely attractive business. In terms of
less than $100, $80, it's fine. You're saying,
yeah,
even though
$100, $80 is fine. And that's blended cost of acquisition, right? So if 20% are coming from referrals, 20% are coming organic, or through a different channel, that all brings your blended cost down. But you want that cost to be, for a $300 product, hopefully $100 or less.
including referral, including those who are coming without any cost of customer acquisition.
Yeah.
20% is what you benchmark to be a good percentage for your question.
Yeah,
No,
it's a huge variability, but yeah.
Okay. No, fair enough. Thanks for your question. Anything else based on what Mujtaba has covered so far? Others?
Yeah, hi, I have a different question. So you were talking about scalability of a product, right? Where you've given the example of 130 people serving 70 million or
not 130, 30, 30.
30, yeah, sorry. Okay, that's more impressive. But so I was wondering, in the education space, is that possible in all models? Because see, I come from a school operator background where you actually talk about teacher-student ratios and things like that. So we are not talking about fintech, right? Where you have a product which can service a large number of people. Isn't education inherently requiring more number of a larger headcount?
It really depends on the model, right? I mean, quizzes does not provide any teachers or have any human element on their team side, right? Quizzes is used by students and teachers in classrooms as a product, as a piece of software with no kind of, Quizzes doesn't do any teaching per se. So of course, they can have a massively scalable model where they don't need huge amounts of staff to make that work. Class Plus, they're not a small company. They have several hundred employees, but Class Plus has like 5 million monthly active users who use the platform. But again, that's because it's a SaaS tool. It powers tutors with their white label apps. So somebody else is teaching, they're not providing any teachers, and sort of that ratio doesn't exist. Now, if you're a company that's doing live learning, especially in small cohorts, of course, like if the instructors are on your payroll, then you're going to have a much larger pool of employees. But the instructors might be contractors, they might be celebrities, they might be influencers. There could be so many different setups, if you will, that will drastically change the equation.
Got it. Great.
Thank you.
Great.
Could you share? Oh, sorry.
Let's take a few more questions, if you're okay with that. Sorry, please carry on.
Thank you. Could you share a few red flags that you saw among the founders that you came across? Maybe a recent one.
Yeah,
no names. I
don't want to be too negative. But I guess things that will happen that are red flags. Number one is if the founder is just building the same company as somebody else. I remember meeting one company and then a week later meeting another company and thinking, is this the same company? Did I accidentally meet this company twice? I was shocked, but that was, maybe like the first month that I was doing this. Now it doesn't bother me at all. Now that, I'm very used to that. So, that's something I've said again and again. That's a big red flag. Other red flags are if the founders are bizarrely happy with things that they shouldn't be happy with. Like we're talking about unit economics. Some founders are very happy that the first purchase is break even, like that their average sale price or their ARPU is the same as the CAC. I'm like, that's a starting point. It's not a victory. It's strange kind of sometimes things that people get excited about. Some founders talk about in their seed presentation their exit strategy. And that's a huge red flag. It just tells you that they're thinking about making a quick buck, if you will. And yeah, I mean, I would be happy if I built a company for 6 months, 18 months and sold it for $5 million. Like, yeah, that'd be great. But as a venture investor, that's not interesting to me at all. It would be totally, pointless for sort of our investment strategy. Yeah, that's a few that are on the top of my head.
Awesome. So, Mujtaba, the pandemic has changed quite a bit of things. Sanket, I'll just come to you after a couple of questions. And others also, please raise your hand. I saw a huge report published by your organization. And as somebody who's an investor in this space, what are the changes that we're seeing in different markets? Say, post-pandemic, or as they say, the Indian market, Chinese market, Southeast Asian market, etc. Are there some common patterns that we are seeing? And if not, what are some of the differences that we are observing in various markets that you've observed?
Yeah, there's certainly similarities and differences across these markets. I would say at a high level that the Indian market is certainly more similar to China and Southeast Asia than it is to like the US market, for example, right? In the US, the culture is for test prep per se, if you're from a middle class or higher family, upper middle class family, your parents will put you in SAT prep or something like that for college admissions. But tutoring is not extremely normal, right? There's no system of, if you're from a financially well-off family, that you go to school, you learn algebra and chemistry and world history, and then you go home and you go to a tutoring center or coaching center, as they call them in India, and then you learn those things again, right? That's not part of the culture. Instead, how it works is if you're struggling in algebra, your parents, if they can afford to, will find you a tutor to help you with algebra, but not really to just review and get ahead. That's usually limited for test prep. Versus right, India, China, Middle East, that's very normal, right? That tutoring culture, if you will. What's interesting is that in Southeast Asia, that exists to a degree, but the driver is actually the child and not the parent. So in India, the parent is the driver of everything, right? The parent is sending them, the parent is signing up, the parent is sort of the decision maker and the driver. In Southeast Asia, tutoring and all this kind of thing is not very common for younger students, for elementary, class 5, class 4, something like that. It is common for older students, for high school students, but it's really the students who are driving it themselves, and it's the motivated students. So there's a much greater dispersion. Not everybody does it, which is very interesting. And there's also sort of a question of, how do the students pay? They might be paying out of their own pocket money, if you will, not from sort of a parental education budget, which is interesting. China's a whole nother beast. We at GSV have taken the position for years that even though we have a great network in China and a great set of relationships, that we didn't, the way Deborah puts it is, we did not feel we were smart enough to invest in China. And we turned out to be quite right about that call. Governments are interesting. I've never, in the last 5-10 years, I've never called myself, I think, a fan of any government. There's always pros and cons of every leader. But in India, you have the benefit of a largely open market, right? And in education as well. Even, higher ed is complicated and the regulations around that, but it's a pretty open market. You are extremely unlikely that you'll see the government come out and just try to shut down the tutoring, the coaching center industry. It's not going to happen. Versus in China, right, you have a much more robust, I don't want to use sort of pejorative terms, but authoritarian state where that's possible. I don't know, maybe it's possible in another country, but it's highly unlikely in comparison. So, that's one of the reasons we always stayed out of China, and now we're quite happy with that decision.
Yeah, I think this happened. Nobody really predicted it, but it really changed the industry in many ways. So I think, thank you for explaining the differences. I would love to get your thoughts on a very popular tweet that emerged a couple of months back that Indian EdTech is basically test prep. Do you agree with that statement? Do you disagree with that statement? And is that likely to change in the years to come?
I don't think that's correct. Like most provocative statements, there's a hint of truth to them, right? I'm sure if you took the biggest Indian EdTech companies, Byju's, Unacademy, Vedantu, Upgrad, InterviewBit, I don't know what I'm missing off the top of my head, sort of the ones that are unicorns or floating around there. They are, test prep would be a big component of revenue. Maybe as a collective, they're close to half, but I mean, it's certainly not everything, right? Byju's now has a huge, I don't know what the percentage is, but a huge portion of the revenue is sort of K-10, right? It's not test prep. It's tutoring for other subjects. It's White Hat Junior, right? Which is not test prep. It's all these other things. The higher ed category, the upskilling, technical skilling category, Upgrad, InterviewBit, Great Learning. If you want to consider emeritus eruditus in Indian business, even though the vast majority of the revenue is outside of India, none of that is test prep, right? That's certification, that's job skilling. That's a whole different category. So yeah, I don't think it's an accurate statement. I think it's true that test prep is a big part of the business. Of course, Unacademy's revenue, Vedantu's revenue will be largely test prep. Class Plus, I don't remember the latest number off the top of my head, but test prep is not even half in terms of the use case. So yeah, test prep is important, but maybe a third to half of Indian EdTech. It's definitely not the whole thing.
That's super interesting. Mujtaba, one thing that we notice after any kind of emergency or a pandemic is that people start focusing a lot more on shorter courses, more ROI-driven education. Every education dollar spent by a family or a person, people want to get more tangible value out of it. Now, I want you to help us understand that when you went to Yale or when people go to Oxford or any of those programs, I don't think you go to learn coding, or you don't go there so that you get practical job skills. That is one of the things that might happen there, but I don't think that's the primary mover. When we look at disruption of education, especially post-pandemic, when people start looking at more tangible tactical programs, they focus almost obsessively on what's my ROI, what will I get? Will I get a job there or not? What's a good mental model to look at the traditional versus newer education models that are emerging? Will we always have both? Will we see one completely disrupt the other? And why do we expect different things from different kinds of institutions that fulfill a similar-ish goal?
Yeah, there's a lot of really interesting points in there. I'll try to organize it as I walk through it. There's different segments of the population, and there's different goals, right? And to some degree, the liberal arts education is a privilege. It's a luxury. I don't know if we'll ever live in a world, or if it makes sense, to scale liberal arts education in a way that it can be accessible to everyone. But it's places like Yale and Oxford, traditionally were for the upper class, the gentry of elite countries, the aristocrats and that sort of thing. If you go to a place, one of these universities, and look at the paintings on the walls and the old students, they were all from fancy families, and they went to fancy prep schools and all that kind of thing. Traditionally those were very elitist and very small programs, right? For very small groups, and to some degree that's still true, right? Like Yale supports, even after they expanded in the last few years, I think 6,000 or 7,000 undergrads, versus the University of Michigan or Penn State or Ohio State or something like that. They support 40,000 undergrads plus each. So to some degree, I think there's a separation, right? If you're in that very elite pool, at least in the US, or at least in the US specifically, right? You can go get quote unquote an education that has nothing to do with skills, or at least like job skills. There's critical thinking skills, writing skills, reading skills, communication skills. But I never I never really used Excel until internships. I didn't, even at Yale, I wasn't even an economics major. I only started taking a few electives sort of in my senior year that were more practical. So that's part of the answer. The other part is just, a core theme at GSV is return on education, is what we say. And for, the mass middle class, whether it's the US or India or anywhere in the world, that is the point of education, right? It's to lift someone up. It's to take them to the next income bracket of society, add additional layer of stability and comfort to their lives, is to, advance them in the world. And that is about a tangible outcome. It's about skills. It's about a better job. It's about more money, a better life, a less strenuous way of living. And in that case, of course, like affordability really matters, scalability really matters, skills really matter. So businesses like Upgrad and one of the people on this call, I think, was doing a $300-400 certification skills type of course. Those things are really, really important. And of course, in the US, whether it's the boot camps or going to sort of a large public institution like Arizona State, which is a partner with GSV, to study a tangible skill, whether that's computer science or finance or something like that, digital marketing, graphic design, that's really important. And I think the future for large swaths of the population. I don't know if that sort of really hit on what you were asking, but.
No, I wanted to get your thoughts on it because before you came, we were discussing the unbundling of education, and a theme that kept coming up was that, what is the purpose of education? What is Yale really? Is it a brand? Is it learning? So thank you for explaining that. Mujtaba, do you feel that Clayton Christensen would be proven right, that half the institutions, universities will go bankrupt? Has the pandemic accelerated it?
Yeah, I don't know about the number again, but just like most of these provocative tweets and that kind of thing, there's always a bit of truth in it. And I'm sure there's studies and some analysis on what percentage of higher institutions are near bankrupt or in financial turmoil. It's probably a quarter or more globally. Certainly in the US, certainly in India. India has like 50,000 colleges. Sort of 10% of those are, the strong. And then there's a mass middle served now by businesses like Sunstone, which are really interesting. And then there's kind of a bottom 20% of mom and pop private colleges, which most of them probably will go bankrupt, and they don't necessarily produce great outcomes or have a wonderful reason to exist, especially if they can be displaced in a good way by technology and education startups, right? The business cycle, innovation, disruption, all these buzzwords, they're about hopefully about making a difference and improving things. And if a quarter of colleges that are not value additive, not helping people get either the liberal arts education that they would benefit from or real tangible job skills, if they're failing at that mission, then they'll go out of business and they'll be replaced by boot camps and online courses that actually help people get jobs.
Yeah. I mean, Network Capital, we call ourselves like a platform that runs cohort-based courses. People come here to experiment, figure out what they want to do with their lives. Then there is On Deck, there is Reforge. So there's this new category of organizations emerging that are trying to rebundle different elements of education together. I think it's interesting, this space. Do you think, what are some things that organizations in this space should keep in mind as they look at scaling? What should be some metrics? What should be some things that they should be careful about?
Yeah, these are really interesting businesses, and I think scale is the key word, right? I have some insight into OnDeck and Reforge, and they're both doing quite well. But from the investor perspective, my question is, can they be multi-billion-dollar businesses? Can you have hundreds of thousands of students and still maintain that sort of really high quality and that prestige and that brand? And can you maintain sort of consistency, if you will, right? A big question that we go back and forth on internally these days is, how do we feel about vertical platforms versus broad platforms? So, very successful vertical platforms just built around data science or, Python or something like that. But there is not yet a vertical platform just for writing at some massive scale or design at some massive scale. There's a bunch of companies in product management, right? Reforge, that's a big area. How scalable is that, and how defensible is that versus a company that does a bunch of different categories like a Coursera or something like that? I think it really depends on the specific niche. What is an area that lends itself to having a sort of singular brand community, and what's an area that can just be sort of another category on a shelf? I think OnDeck is really around tech and startups, right? If you look at it, it's OnDeck founders, OnDeck chiefs of staff, OnDeck design, OnDeck no code. I think there's dozens now, but they all have something to do with tech startups or some part of that ecosystem. Even OnDeck writing, I think, is filled with people who are like Substack writers. It's very catered to that ecosystem. Can the tech startup ecosystem sustain a business just around advancing your career and skills in tech and startups? Probably. I mean, it's a massive ecosystem. But how many of these businesses should exist? At what point do Reforge and OnDeck compete with each other? To be determined. It reminds me, if you want to go this direction, to the whole sort of cohort-based courses bonanza going out in the world.
Yeah.
What we like to say at GSV is a cohort-based course is basically a class that any of us did ever in our entire lives, whether that was in pre-K or in university, or even this group right here. Everything is a cohort-based course largely. It's now it's being treated as a new thing because it's a revision to the MOOC model, right? Or where you're one of many or in an async class. Again, how many of these platforms should exist? Why do there need to be a few different players or a dozen different companies that are all platforms for people to teach courses? What's the difference between a Maven and a Teachable and a Disco, and there's a bunch of Indian ones as well, but those are the ones that come off the top of my head. So far, what we've seen is the real difference is, again, what verticals they focus on and who are sort of the teachers or influencers that they attract to be on their platform. It'll be interesting to see if one of them can gather enough momentum and enough credibility and enough influencers in one category to build a big business. But that's sort of the question for now.
Yeah. No, I think your answer is very comprehensive. And we hosted before you Mercedes Bent, who's like a peer from Lightspeed, and she tweeted something very similar. Cohort-based course, CBC, is an interesting, branding for class, something that we've always taken, but in the pandemic, it's just like turned out such.
Yeah.
But when we look at CBCs or classes, as investors in Coursera, you would have noticed the low completion rate in MOOCs. So is it likely that some of these MOOC platforms will launch their own live classes, or is that already happening? And what have some of these platforms done to increase the completion rates? Because every time you say MOOC, people say completion rates are low.
Yeah.
So
it's become a trope, and I think
it's become a trope.
It's, again, like most things, it's only partially true. Sure, for a generalist Coursera course about, like the art of happiness or something like that, it'll be thousands of people have signed up, and, there'll be, the cohorts will kind of thin out over time, and, maybe something like 10% of the group will finish the course. For their business and for the platform, that's totally fine. what's important for the businesses in their corporate offering and online degree offerings, that they actually have really high completion rates on the paid products, right? On the sort of quote unquote more serious products. And they understand that it's not really an issue, if you will. Of course, there's EdTech 1.0, EdTech 2.0, there's waves, and there's different models, and many people today are sort of focused on solving for engagement and completion rates and all these different things. I just think folks should keep in mind that different businesses have different models. When some of these companies, that if you look at a company like Upgrad or one of the skilling companies, the completion rates are really high. They're like 85, 90%. But then you think about it and you say, of course they are really high. They better be really high. If someone pays $2,000-3,000 USD for a Python course that's supposed to help them get a job, I hope they complete it. It'd be really problematic if they didn't complete it. It suggests that the offering was terrible.
Awesome. That's we were discussing this right before you came. Thanks so much for laying it out. Last question from my side, and then I'm going to turn it over to my colleague Barya, because I have a school program to teach in 5-6 minutes. All of our students in the class, some of them are trying to launch their companies, some of them are trying to scale, some of them are operators. Any just like one piece of contrarian advice, or just one thing that you would want them to remember in terms of where to play in the education space in the post-pandemic era?
I don't know about contrarian advice.
Or any advice. Let's not put additional pressure on.
I would say, hopefully it doesn't sound too cliche, but focus on your strengths and focus on what you understand. The best investors always invested in companies that they really understood what they were building. The classic Warren Buffett mantra, he didn't invest in technology for decades because he said he didn't understand it. And in the same way, the companies that we've invested in that we are most impressed by and that are performing the best are because the founders really understood the problem that they were solving for. They call it founder market fit, right? Baiju was a tutor on the side, right? His story is really entertaining. He knew what he was doing. He was a massive, influencer in education, if you will, and he built a business around that. At Lead School, which is a company that we're investing in that we love, right? Sumit and Smita, they were each running education businesses. One was running a nonprofit, and another was running a school chain. Like, they understood what they were solving for. Mukul and Baswa at Class Plus, they became friends and met in coaching classes in class 11. And they became really good friends because their coaching center closed and they had to finish their course of study for their entrance exams together as a pair without the center. So they really understood, how those businesses run, what they need to survive, and they went and tackled that problem. That's, usually what builds a great business is some sort of real passion and understanding of the problem.
Yeah, great. Thanks so much, Mujtaba. So appreciate your time and look forward to having you back with us. EdTech is evolving so fast that perhaps our next EdTech fellowship will cover lots of different points. But I hope you enjoyed a ton. Over to you, Barya. Please keep the conversation going. I think fellows had questions. Thanks, Mujtaba. Take care. Bye.
Thanks, Utkarsh. We have a couple of minutes left, so maybe we can take questions. Sanket, do you want to get us started?
Yeah, sure. So Mujtaba, I think in one of the questions that was asked, I think I saw you were asking follow-up question related to the renewals, right? And I have spent like 10-12 years in education, but in EdTech specifically, I have been working for the last 1 year. And I see that there is a lot of emphasis on renewal and retention. So just wanted to understand from an investor point of view, like why it is like, is it that important? And are there some exceptions to it, like depending on the product that you see where, renewal may not have like that important
certainly.
consideration?
There's segments in which it's less important, right? So in the high price skilling segment, if you're selling a $40,000 executive MBA, there should be no retention and no renewal, right? It's a one-time purchase. But if you're selling a $2,000 course on Upgrad or something like that, again, there may be some second-time purchases, but not high. And if somebody takes a 9-month course on data science and gets a job, maybe a few years later they'll need some refreshing, or to try to add a different skill. Maybe they'll want to go into design, but there's probably not a compelling reason for them to buy something else, at least soon. But if you're selling a 3-month course package for someone in class 5, I mean, the retention would hopefully be 40-50% 1-year retention, so that you can actually sort of extend that tail. We're invested in a global online high school called Valenture Institute, which is founded by Rob Paddock. The Paddock brothers started Get Smarter and sold that business to 2U. It's a really interesting business, and if you're building an online school, like a proper school for K-12 education, the retention and the lifetime should be really, really long, right? Somebody should start in grade 5 and then go to grade 6 and grade 7 and go to grade 8 and go to grade 9. So it of course depends on the business model, but the repurchase and retention also need to be decoupled a little bit, because retention could just mean it could be a proxy for completion. If you're looking at months, for example, if it's a 9-month course and month 6 retention is only 50%, that means your completion rate is less than 50%. Yeah.
Yeah, thank you, Mujtaba.
Thanks. Sanya, would you like to go next?
I can't
Sanya,
hear
we
her.
can't hear you. No, we can't hear you.
I hope you can hear me now. Can you?
Yes.
Yeah.
Thank you. Hi, Mujtaba. My question is related to the importance of platform when it comes to an EdTech company. This is more related to, if community and EdTech is coming together, then sometimes it's very difficult to have a homegrown platform. So you start adopting. So just as an example, Upgrad has just come up with Graphy, and it's allowing communities to get built, content to get built. Is it advisable for EdTech companies to use such common platforms, or is it really important from an investor perspective to go homegrown?
I think it depends on the nature of the community and the stage of your business. I think a lot of businesses have nice community, have big WhatsApp groups or like a massive Discord channel or something like that, which are appealing. Like when I meet someone and they tell me that there's 25,000 high school kids or college students in their Discord channel, I think these guys have a following. Like people care about what they're doing. I think if your business is to monetize that community, then depending on what you're trying to sell them and how, having them on a platform might be really important. Because it's all about reducing friction at the end of the day. If someone has to move between between Zoom and your app and Discord, it's just might harm your product experience. So I would say, having a platform is nice. I think sort of at a seed stage, especially if the company's already built a following on Discord or something like that, it can be tough. Yeah.
Cool. Thank you.
Great. Do we have any other questions? Yeah, Ananya, go ahead.
Just had a quick question. Hi, Mujtaba. So the question is more on sort of, if you could expand on the employability bit that I think was touched upon a little bit, but how important is it for trends to come to match sort of employability with education? That is something that I've been grappling with. And I don't know if you've been sort of seeing that from an investor lens, where it is important going forward in order to convince more people to kind of get them into the funnel of education in the first place. So
to make sure I understand, do you mean, like, is it important that now that AI ML is a huge trend, that there's AI ML courses? Like, I'm not sure I fully understand.
Yeah, is it important to have sort of an outcome which directly relates to employment with education?
Oh yeah, and I think I think I get it, and it ties back to what was being asked earlier around like liberal arts versus data science. I think in general, I think yes, in general, right? I think most people, if they're signing up for, if they're general, well, maybe this is hard to generalize. I think it's at the core, it's people need to get what they're looking for. So, if you're providing I would say there's one of our partners, Adam Freed, who just joined GSV. He used to be CEO of Etsy, spent a long time at Google, was CEO of Teachers Pay Teachers, which is a really interesting education business. He says that everybody has two selves, an aspirational self and an actual self. And masterclass is for your aspirational self. You know that by watching Serena Williams play tennis, you're not going to become Serena Williams. And your tennis game is not really going to improve. You're watching it really, it's edutainment, as they say, for an experience. And you know that when you're getting in. If you think you're going to improve at tennis or become Serena Williams, you're a little delusional. But if I go and take an emeritus course for $3,000 on graphic design, I'm probably looking to get a job in graphic design, and I probably care about placements and actual skills and a tangible outcome. But I could take on something like a class party or a My Captain, or in that category of business. I could go take a graphic design course that's a month. It's $50. It's live on Zoom with somebody who's in their 20s, and I'm probably just taking it because I like graphic design. It's a hobby, and I want to get better, and I care about sort of an outcome, but the outcome is not super measurable. It's not a new job or a raise or something like that. So there's a spectrum, right? And I think the most important thing is that you know what you're selling, in terms of, it's really important to know, like, are you in the middle, or are you very serious? Are you purely recreational? And that matches with your customer base and your price point and sort of the depth of your product, right? These things like an on-deck cohort is like, it takes like 10, 15 hours a week. It's expensive. It's a few $1,000s or more. So there should be some really tangible outcomes. But yeah, that's kind of the price, involvement, seriousness spectrum, if you will.
Thank you.
Okay, great. Mujtaba, thank you so much for this session. I think it's been really interesting. Before we let you go, I think the final question we have is, what is the last thing you've learned online, or what is the last EdTech product that you've used for yourself?
I actually just finished an on-deck cohort on investing. So that's like a real thing, if you will. What else do I use? I take a class. I take a class but it's not like doing an EdTech product. It's a group of people that I know, and they do the class like weekly on Zoom as a group. And it used to be offline, so like I knew these guys beforehand, kind of thing. But yeah, I mean, the on-deck is a real product. In terms of something like something that's on like Coursera or anything like that, I haven't done an online class like that in a long time.
Okay, great. One of the assignments that all fellows did was basically create their own unbundled education learning system. What are the courses they'll take from whom, and how they'd spend their time learning online. So just building on that.
Yeah, it takes a lot of time. Like if you want to take a serious course, it's not a low energy time commitment, right? It's pretty intense.
Yeah. Thank you so much for joining in, and thank you to all the fellows for your questions. Hope you were able to find this interesting. And I look forward to seeing you all again. Thank you.
Yeah, it was fun, folks. If you have startups, feel free to add me on LinkedIn and pitch me. If any of you guys are building multi-billion-dollar companies, I'd love to meet.
Yeah, we'll send all brilliant EdTech products your way from Network Capital.
Yeah, Mujtaba at GSV.com.